Welcome to The Explainer. Today we're taking a super practical and honestly pretty fascinating journey through the mechanics of Singapore's individual tax system. And we're tailoring this specifically for expats. So whether you're, just negotiating your very first contract, maybe you're already there enjoying the local perks, or you're actually getting ready to pack up and move on to your next global adventure, this explainer is absolutely for you. From the minute you land to the day you leave, we're going to decode the ground rules, the unexpected benefits, and those sometimes shocking exit taxes.
Now, before we really get into the weeds, I've got a question for you. Is Singapore really just this simple, entirely tax-free haven where your earnings are completely untouched by the taxman? You hear it all the time, right? It's a hugely common myth. But the reality? Well, it's a lot more nuanced and, frankly, a lot more interesting. Let's go ahead and separate the facts from the fiction and see how this system actually works in practice.
Okay, let's dive into this. Our roadmap for today covers 6 main stops. 1. Singapore tax basics. 2. Are you a resident? 3. Defining employment income. 4. Benefits and perks. 5. Equity and shares. And finally, 6. The exit tax. Starting with Section 1, Singapore tax basics, the foundation.
The whole Singapore tax system is really built on a few core pillars. First up, it operates on a territorial basis. That's just a fancy way of saying you're only taxed on income that is derived in or from Singapore. Simple enough. Second, it uses a preceding year basis. This is a super crucial detail to remember. Your tax is assessed on the income you earned in the prior calendar year, so strictly running from January 1st to December 31st. And third, the big one, the headline-grabbing perk that brings so many professionals to the country. Generally speaking, Singapore does not impose a capital gains tax.
Moving right along to Section 2, Are you a resident? The residency test. It literally all comes down to this magic number right here, 183 days. The quantitative test for residency in Singapore is as straightforward as it gets. If you are physically present or you're exercising employment in Singapore for 183 days or more in a single calendar year, congratulations, the tax authority officially views you as a resident. And this brilliantly illustrates exactly why hitting that 183-day mark matters so immensely to your wallet. If you lock in that resident status, you get the benefit of graduated progressive tax rates. Those start at 0% and cap out at 24%. Plus, you're entitled to personal reliefs, which can seriously lower your taxable income. But what if you're a non-resident? Well, you get hit with a flat rate of 15% on your employment income or the resident rate, whichever happens to be higher. And the real kicker? You get absolutely no personal reliefs. None. It's a pretty stark financial contrast for sure. But wait, there's a massive exemption here that you need to know about called the 60-day exemption rule. Say you're someone like, let's call her Miss Ice from our source data. She works for a U.S. company and frequently visits Singapore for short business trips. Because she's considered a non-resident short-term visiting employee, if her total cumulative time in Singapore adds up to 60 days or less in a calendar year, her employment income is completely exempt from tax. Incredible deal, right? Quick warning though, this generous rule does not apply if you happen to be a company director or a public entertainer. All right, on to Section 3, Defining Employment Income, the paycheck. The tax authority looks incredibly closely at the exact nature of your relationship with your work. Are you under a contract of service or a contract for services? One little letter changes a lot. If it's a contract of service, you're an employee. There's a master-servant relationship, which, is a slightly antiquated legal term, but it basically means you're part of the company headcount and you're taxed under Section 10(1)(b). On the flip side, if you're under a contract for services, you're essentially a business owner or a freelancer. Your income falls under Section 10(1)(a). This delineation is huge because the rules for claiming deductible expenses are way more restrictive for traditional employees than they are for freelancers.
Let's anchor all these abstract rules with a real-world scenario. Meet Molly. She's seconded from her U.S. parent company to work over in Singapore. Her job requires her to spend 75% of her time working in Singapore, but her employer actually pays 50% of her salary directly into her U.S. bank account. Now, you might logically think, okay, she only pays Singapore tax on the 50% that actually lands in her Singapore account, right? No way. Because she is actively exercising her employment in Singapore, that income is deemed to be sourced there. She's fully taxed in Singapore based on her employment there, completely regardless of where the cash actually physically lands. Section 4, Benefits and Perks, the surprising quirks. Let's get into the fun stuff. Because as you'll see, not all perks are created equal in the eyes of the taxman. The authority actually grants administrative concessions for certain things that just foster goodwill, meaning they let it slide tax-free. So corporate zoo passes, subsidized pantry food, per diem allowances, as long as they're up to an acceptable rate, those are non-taxable. But the heavy hitters, the major perks like your company paying for your housing, flights back home for your annual leave, and the private use of a company car, yeah, those are fully taxable benefits in kind, and they will absolutely bump up your end-of-year tax bill.
Now, what's really interesting here is this very specific number, $200. This is the strict threshold for festive gifts, think like a Chinese New Year hamper, or a token award for, say, passing a professional exam. If the value of that gift is $200 or less, it completely remains non-taxable. But if your boss is feeling extra generous and gives you a gift worth $201, the entire value becomes taxable, not just the $1 over the limit. The whole $201 is taxed. And hey, if you're lucky enough to actually get a company car, there is a very rigid formula to figure out your taxable benefit. The system literally chops up a standard 7-day week. They assume 4 days are strictly for business and 3 days are for your own private use. So they apply this 3-7 ratio to the cost of the car and its running expenses. That 3-7 slice, which represents you just driving around on the weekend, is calculated and added directly straight to your taxable income. Next up, Section 5, Equity and Shares, demystifying the acronyms. If you're an expat, in your contract, you're almost definitely going to encounter two main terms, ESOP and ESWO. An ESOP, an employee share option plan, gives you the option to acquire shares at a set price at some point down the road. An ESWO, an employee share ownership plan, is the award of the actual shares themselves, though, they usually come with vesting periods. The absolute most important thing to grasp here is the timing. The taxable event usually doesn't actually happen when you're just granted these perks. It triggers later when you exercise the option to acquire the shares, or if there's a restriction on selling them, you're taxed at the exact moment that sale moratorium is finally lifted. And finally, Section 6, the exit tax, leaving Singapore. So the crucial point here is wrapping your head around Section 10.7, which is way more commonly known as the deemed exercise rule. This is a massive, highly unique rule that specifically targets non-citizens who are leaving their employment in Singapore. If you have unexercised options or unvested shares just sitting in your account when you quit or get transferred, the tax authority essentially just pretends you cashed them out. They treat those shares as having been realized for a final tax gain, and this crazy calculation takes place 1 entire month before you officially cease employment. Let's move to and see how this actually builds across your timeline as an employee. At time 1, you're granted the equity while you're happily working away in Singapore. Under normal circumstances, you just wait for time 2, that future date when the shares finally vest or you exercise your options. But if you decide to leave the country, you immediately hit time 3, tax clearance. Under that deemed exercise rule, you are taxed at time 3 on those deemed gains. Let me repeat that. You have to pay tax on phantom income even if you haven't actually received or sold a single share yet. Which leaves us with a rather provocative question to end on. Are you actually prepared for a massive tax bill on unrealized gains when you pack your bags? It perfectly highlights exactly why understanding your entire tax life cycle from day 1 is so critical. Exit planning isn't just about, booking the moving trucks. It's about actively strategizing your equity and prepping for your final tax clearance. Review those compensation packages, know your residency status inside and out, and whatever you do, do not let the exit tax catch you off guard. Thank you so much for joining me on this explainer. I really hope it gave you exactly the insights you need to navigate the system. Happy learning.